You've heard the truth, haven't you? You've heard that 90% of traders fail. But the real truth is something far simpler and far more brutal. Most men don't fail because the market is rigged. They fail because they are standing in front of a mirror, fighting their own reflection. They are fighting human nature. The market will give you 1,000 opportunities every single week. But here is the question that separates the wealthy from the broke. How many are worth the risk? For nearly a century, one man, the legendary Jesse Livermore, answered that question. He mastered a simple yet brutal philosophy. Trading is simple, but it is not easy. Today, we are stripping away the noise, the indicators, and the confusion. We are going back to the foundational principles that made Livermore the most feared speculator of his age. In this video, I will show you 1. Why inactivity is often your most profitable position. 2. The only setup where the market practically declares its intention, the ace in your pocket. And 3. The unbreakable law of risk to reward that turns gambling into a business. Stop gambling, start speculating. And before we dive into the deep end, do me a favor. If you're serious about trading this business with the respect it deserves, hit the like button right now. It tells the algorithm that this is serious content, and it helps us spread Livermore's lessons to every aspiring speculator out there. And if you haven't yet, subscribe and ring that notification bell, because the truth we share here will fundamentally change the way you see the market. Section 1. The core philosophy. Patience is a position. Livermore knew that the market's greatest danger is not volatility, it's eagerness. It's the impulsive desire to always be in a position, as though sitting on your hands proves you're not a real trader. Livermore's lesson: inactivity is a position too. This is where the fight begins. The market is moving, prices are flashing green and red, and your brain is screaming, do something, you're missing it. That feeling, that pressure to act because of fear of missing out, is what brokers love. It is what costs you money. Daily life comparison: the hunter's patience. Think about a hunter. A young, inexperienced hunter will fire at every flicker in the brush: a squirrel, a bird, the wind. They make noise, they waste their limited ammunition, and they return home empty-handed. But the master hunter, he understands that his time and his bullets are capital. He waits, completely still, sometimes for hours, for the single high-value target that justifies the risk. The market is no different. You get 1,000 setups, but how many are the master hunter's target? Maybe 5 a year? I spent years making money, losing it, making it again, and losing it again, until I realized this simple loop. Most of you see a stock move up 2 points and you grab your tiny profit like a squirrel grabbing an acorn, because you're terrified it will vanish. You trade for the excitement, not the profit. You trade for the sake of being in the game. How many of you jumped into a trade purely out of boredom last week? Be honest. That is human nature, and that is the enemy you must conquer first. Discipline is not a feeling, it is a calculation. It is the wisdom to say, the risk outweighs the opportunity right now. I will wait for the wind to be at my back. Section 2. The ace in your pocket. Breakout after consolidation. What makes a setup high probability? It is not some complex indicator. It is the market leaving its footprints for the big operators. It is the market declaring its intention. The most reliable setup, the ace in your pocket, is the breakout after consolidation. Mechanics, coiling energy. A stock does not trend forever. It surges, then it rests. This resting period, the consolidation, is where prices fight in a narrow range. The amateur sees boredom. The master sees preparation. Daily life comparison. The sprinter's coil. Imagine an Olympic sprinter. The race is 100 meters, but the real action is in the seconds before the gun fires. The sprinter gets into the blocks, they are quiet, still, coiling their entire body's energy. The longer they hold that tension, the more pressure they build, the more explosive the release will be when the gun sounds. A long consolidation is the market in the blocks. Weak hands get worn out and sell. Strong institutional hands use the quiet to accumulate without driving the price up. 2.2. The proof, volume, and confirmation. The mistake most traders make is rushing in before the gun fires. They will the breakout to happen, hoping they catch the bottom tick. This is the trap of anticipation. High probability trading demands proof. Proof is expensive, yes, but it is infinitely cheaper than hope. The confirmed breakout is a decisive move above resistance, backed by conviction volume. Volume is the only language that tells you if the big money is involved. False breakout. Price pokes its head above resistance, but volume is thin. It's the market teasing the eager amateurs. It collapses quickly, trapping the weak. True breakout. Price surges through resistance with a surge in volume. This is demand overwhelming supply. It is the chain reaction of frustrated short sellers covering and hesitant buyers rushing in. Live scenario example. The 4-month base. Let's look at a scenario. Imagine a fictitious stock called Future Energy Systems, ticker FES. FES has been trading between $48 and $52 for 4 solid months. It's dull. It's been overlooked. Everyone is bored and has moved on to flashier names. Then on Tuesday morning, FES opens at $53.50, and in the first hour, the daily volume target for the entire week is surpassed. The price holds above $52 for the entire day. That, my friends, is the market speaking in a clear, loud voice. That is your high probability entry point, risking a stop just below the 52 breakout level. You are not just buying the strength, you are buying the forced buying of everyone who sold short or hesitated for 4 months. That is the tide you must ride.
Section 3. The Unbreakable Laws, Trend and Risk to Reward. Once you have your entry, you need the twin pillars of protection and profit potential. Section 3.1. Law 1. Never fight the prevailing tide. Respect the trend. Never forget, trends exist because the majority of capital, the big operators, have chosen a direction. Fighting them is a fool's game that will exhaust your capital and your soul. The mental strain comparison. Consider the mental strain. Fighting the trend. Shorting a rising stock. Every tick higher adds pain. Your conviction erodes. You're always anxious, always questioning. Riding the trend. Buying a rising stock. Pullbacks are expected rest stops, not reasons to panic. Rallies are expected confirmations. You can sit with calm and let the market do the heavy lifting. Time and again, I see men trying to pick tops, convinced they are smarter than the entire market. They crave the recognition of saying, I sold at the very high. I'll tell you this, trying to pick a top is like trying to convince your teenager their music is bad. You're just wasting energy and you'll likely get shouted down by the price. Profits pay the bills, not ego. The trend continues until it is broken, not before. You must define your trend. Is it higher highs and higher lows? A moving average? And you must stick to that definition. A single bad day doesn't end a trend. Panic does. Section 3.2. Law 2. The business of risk to reward, the profit filter. Every position carries danger. That is the cost of doing business. But the high probability speculator calculates the cost before he steps in. Risk to reward is the foundation of sound speculation. A high probability setup is worthless if your potential gain does not sufficiently outweigh your potential loss. Live scenario example, the restaurant margin. Imagine you are a successful restaurant owner. Your most popular dish costs you $5 in ingredients and labor to create. You sell it for $20. Your RR is 1 to 4. You accept that one plate in 10 might break, costing you $5, but the 9 others bring in $135. Profit. That is a viable business. Now imagine your accountant tells you to buy a $100 ingredient to sell a $50 dish. Would you do it? Of course not. That's not trading. That's a charity that will bankrupt you in weeks. Yet this is what most traders do. They risk $1, their stop is close, to gain $0.50. Their target is small because they are afraid to let their winners run. The rule: you must demand a minimum 1 to 3 RR. If you risk $100, the distance to your stop, your target must be at least $300. This single principle ensures that you can be wrong half the time and still build a fortune because your winners pay for all your small controlled losses and then some. Ask yourself right now, do you enter a trade without defining your profit target and your stop loss first? If the answer is yes, you are not trading. You are handing your money to the market on a silver platter. Conclusion: the road to mastery. The truth about trading is not complex. It is simple, but it demands character. You now have the 3 pillars of high-probability speculation handed down from a titan. 1. Patience is your capital. Wait for the wind to be at your back. Inactivity is the most profitable position you can hold. 2. Demand proof. Hunt the breakout after consolidation, where time, exhaustion, and institutional accumulation leave clear footprints. Wait for the volume surge. 3. Respect the business. Never risk $1 to make less than 3. Align with the trend and let your winners ride long enough to justify the entire process. This is the rhythm of the market: consolidation, breakout, trend. It is the heartbeat of speculation, and it will not vanish as long as human nature remains unchanged. It is harder than chasing every flicker of price, but it is the work that pays. The decision is yours. Do you continue to fight the market and fight yourself, or do you dedicate yourself to the discipline of the high-probability speculator? If this video has clarified your mission, if it has given you the courage to wait for your pitch, then do 3 things right now. 1. Subscribe to the channel so you never miss another deep dive into the secrets of the masters. 2. Like this video to lock these lessons into your own trading psychology. 3. Share this video with one fellow trader who you know is tired of losing. Your fortune is not made in the excitement. It is made in the boredom of waiting and the courage of holding. Go out, study your charts, and trade with purpose. You will see you in the next session.